Here with his take on the results is Jefferies Managing Director Randy Konik. He's got a buy rating, a $115 price target on the stock. Randy, great to have you with us.
Hey, how are you?
You have said, even prior to the earnings, just buy it. How do the first quarter guidance points, how do they stack up what you're expecting?
Melissa, look, plain and simple, these results are terrible. But the good news here is that terrible was expected. And as you said in your lead-in here, the revenue expectations for the next quarter down mid-single digits, that's a massive improvement. And what they said on the call, which I think is very important, is that performance is working, order book is up. And if you take that perspective and say, wait a second, this company has the easiest comparisons in all of consumer discretionary over the next 4 quarters, you have to own this stock right now.
They also they just talked about just moments ago on the conference call, the tariff costs over time. They're saying a gross cost increase of $1 billion due to tariffs. They're also saying they intend to fully mitigate the tariff costs over time. What does that mean for margins, Randy? Are they just eating it?
Look, in the near term, it's not great for margins, but it doesn't matter. Here's what matters. Because they signaled that the revenue part of the business is improving sequentially and the product is trending, the market's going to look past the margin problem and start to look through fiscal 26 into fiscal 27. So if we're thinking out 8 quarters, the business should improve from a margin trajectory, especially on these mitigation efforts to improve product cost, move production around, and then take some strategic price increases on certain products. I think that's a winning formula ahead. And what we've tried to counsel clients is look through 26 and look into fiscal year ending in May 27, when we think there's going to be a V-shaped rebound and this stock can double from current levels.
Randy, hope things are good down on the ranch there. I guess, so where do you put the multiple on this thing? Because by 27, I've read your research. V-shape stood out to me, so that means you're probably back around $4 a share or somewhere around. Or is it that high? Because I know we closed fiscal 24 just below 4.
Yeah, look, I think this is a super great mathematics exercise. This is a company that's gone from $4 of earnings down to $2 of earnings. It's going to be terrible in the next fiscal year, the next 4 quarters, but in the 8 quarters from now, we think they actually get back to $4. This company trades usually at in and around 25 times. I've covered retail forever. When you see turnarounds happen in these stocks, they trade above their normalized range. So that's why we're putting a high 20s multiple on $4 of earnings in 2 years out, fiscal years out, that is. And then when you look at this stock, keep in mind, this company did last year about $50 billion of revenue with a market cap of 88 or just under $90 billion. Its lowest price to sales multiple in 15 years. Its lowest market cap in a decade. This is the number 2 brand of ubiquity behind Coca-Cola in the entire world. That's why you need to own this thing right now. And we've been a big short seller of Lululemon. And we want to be buying this Nike and shorting Lulu against it.
No, that's fair. And listen, Tim, you're basically preaching to the choir in terms of Tim. So I think part of this, though, says competition is going to be basically what it is now. It's going to be the same in a couple of years from now. There's not going to be an acceleration. The margin deterioration, which they just talked about, we talked about their inventories being flat year over year. Sales were down 12%. I mean, that all sort of goes away. And then you can make a case, I guess, on valuation. But this has been 4 years in the making in terms of the stock, upper left, lower right.
Well, you're right. We didn't like it for a few years, and we upgraded it in February, maybe a quarter too early. But that's when we upgraded. So I agree that it's been a terrible situation for a number of years, but it had a terrible CEO in the past. That CEO was changed. This CEO that came in, Elliott Hill, in October, he's the home run. So if you think about the competitive set here, what people forget about Nike, there's only 10 competitors that matter to Nike. Whereas with Lulu, they have hundreds of competitors, thousands of competitors in apparel around the world. So Nike's in the right category. Nike's is the number 1 brand. Competitors like Hoka and On, I know everyone's hyped up over On Running, On Holding. We have a hold rating there. But you know what? What On Running doesn't have? It doesn't have low price points. It doesn't have a big apparel business. Nike is the only brand that has the global awareness. It's the full lifestyle across all the price points from rich people to poor people. That's why this stock is going to work massively over the next 12 months and why you want to own it right now.